Hey everyone, welcome to another video on my channel, and today in this video I am going to share a strategy for long-term options. So I'm going to tell you why I am doing this because of the upcoming election. So we have already seen the VIX go up from 10 to 25 today, and this is a general case scenario whenever election comes or a budget comes. So the VIX generally shoots up. So once the VIX goes up, it provides a really good opportunity for us to play with long-term options. So I have already made a video on this last week, but I had to remove that due to bad voice quality. So I'm reshooting this, but this video I'll be doing in much more detail. So I'm going to show you how long-term options are going to benefit much more than the short-term options when the VIX starts to fall. Not just that, I'm also going to show you some simple adjustments what you can do in case if we have seen any big move post the elections, right? So all this will be covered in this today's video, so make sure that you stick till the end. And also, if you are finding the content on this channel valuable, don't forget to hit the like button, share this video and hit that subscribe button right away, right? So now let's quickly move on to the screen recording. Before that, you can also support our work by opening a First Stock account using the link in the description below. You will be getting 2000 rupees free brokerage credits, and not just that, you will also get platforms like FinTarget and FitDiscretion absolutely free to use. Make sure you check that out, and let's move on to the screen recording. Hey guys, welcome to the screen recording, and right over here I have opened the weekly chart of VIX. So one thing that is quite evident from the very first sight of VIX is basically VIX has started to go up from the month of April. So you can see it was hardly around 10 and currently VIX is trading around 25, right? So today we have also seen the market turn little volatile, and from the past 5 weeks VIX has been continuously going up, right? So what we will also try to see is how VIX has actually done during the previous election time, right? So this is what is happening currently. Let's move on to April and May of 2019, right? So that is when we had another election, right? So even here you can see VIX was trading around 15, and as and when we approached the election, VIX shot up all the way to 30. Now let's go back to 2014 again in the month of April and May. So you can see right over here, VIX back then was trading somewhere close to around 14. It was around the level of 14, and it shot up all the way to 37 before the election. So there was a steady increase in VIX for almost around 4 to 6 weeks. So this is the weekly chart. But what is more important is what really happens right after the election. So you can see the very next week after the election, the VIX has actually crashed, right? So this is not just in 2014, even if you come to 2019, you see that the very next week, the VIX has actually come down quite a lot. So it has almost halved hardly in the matter of a week. So now let's simply come to the daily chart. So now we'll take a look at VIX around the same period. Let's go to 2014, May month. So as you can see, in 2014, 16th May, we had the election result, and on the same day, you saw the VIX crash by almost around 30%. And sometime even in 2019, the election results came, I think, on 23rd of May 2019, and you can see again the same day VIX fell almost close to around 30%, right? So what we can see from this is on the election day itself, even though the market is moving violently, the VIX is almost crashing by 30%, and within the same week VIX has also gone on to crash almost around 45 to 50%, right? So this crash in VIX or crash in volatility can be made use very well using the long-term option. So these are called as short volatility trades, right? The effect of this volatility is generally seen the highest on the long-term option. So let me just show you that, so you will get a better idea on how volatility is going to affect different kinds of options. So right over here, just to show you the effect of volatility on different expiry options, I have opened stock mark, and what I'll be doing is, let me just go to the 7 days to expiry or 7 DTE option, and let me just short a Bank Nifty put option, right? So you can see the effect of Vega on this both put and call, ATM straddle is what I'm doing, is almost around 26. So what does it mean? So in case if the VIX comes down by almost around 1%, then this option premium is going to straight away crash by 26 rupees. So VIX currently is trading around 24. If it becomes 23, these two options are going to straight away lose out 26 rupees each, right? So now what I'm also going to do is maybe go towards the June end option, and let me create a short straddle here. So you can see right over here, the short straddle of June end is having a Vega of 53. That means for 1 point drop in the volatility, these options are going to lose 53 rupees. Similarly, let's go even further and let's go to December end option and see what exactly will end up happening. So these are Bank Nifty options, but assuming that, right? So I create a short straddle here. So you can see the December end options are having a total Vega of 148 rupees. So that means for every 1% crash in the implied volatility. So VIX is basically a broad measure of volatility. So Vega, what exactly it does is for 1% change in the implied volatility or IV of the options, right? So we are not exactly referring to VIX, but we are referring to the IV of the option. So for every 1% change, this is actually going to come down by 148 points. So you can see that this is the current week and this is the December end option, right? So how exactly Vega is having a huge impact on far expiry option compared to the closer one. So whenever the implied volatility is going to change by 1%, so VIX is a measure of the general volatility, but we are referring to implied volatility of the options. So whenever it is changing by 1%, the highest effect is seen on the December end option. As and when we start coming closer to the expiry, the effect of volatility on the option is going to slightly decrease and decrease. So right over here, what we have seen is a steady increase in volatility over a period of time, right? So due to this, so when I say over a period of time, almost from close to around 4 to 5 weeks, the volatility has steadily been going up. So since the volatility has steadily gone up over the past 4-5 weeks, and we know for a fact that post the election, volatility is going to drop drastically, right? So you can make use of it, and the best use case is when you actually start shorting far expiry option rather than closer to expiry option. So now just to show you how exactly the volatility has influenced the option price or impacted the option price over the past couple of months. So I have opened simulator on StockMark, right? So right over here, I have come to the day of April 1st, which is almost 60 days prior, right? So here, let me go to the June end option. So that means totally this option has an expiry 90 days later, right? So here what I'm going to do is end up shorting, let's say 20,000 rupees put option, and let me short 25,000 rupee call option. So both were trading at 60 and 60. Generally what happens is whenever you are shorting 3 months option and the market is trading in a range of hardly close to around 500 points for 60 days out of 90 days, so these options will more or less end up giving away full premium by this time. So let me just show you the blue line. So assuming that I am going ahead by say 30 or 40 days and there is no change in volatility, right? So there is no change in volatility, and let's come to 29th of May. So as you can see here, by 29th of May, these two options technically should have given us the entire decay, right? So if you see the target P&L blue line also, these options will be trading somewhere around 5 rupees and 10 rupees. But let us see the same options, what price they are trading today, right? So let me just change this and come to 29th of May. So right over here, you can see I have come to 28th of May, right? So this particular option, in spite of passing almost around 60 days, has hardly given up 14 points, and the other option has given up 20 points. So this is because the volatility has steadily gone up, right? So the IV has increased for these options, VIX has increased, and that's the reason these options have hardly given up anything. So even if you actually take a look at the option chain for FAR OTM options, so if you see on April 1st, right? So what you can see here, 19,000 put option of June end was trading around 24 rupees on April 1st, and today we are on 29th of 28th of May, right? So you can see the price of 19,000 option. So it was around 25 rupees, and today the same option is trading close to around 22 rupees. In spite of 60 days passing by, this option has lost just 1 rupee. The same thing can also be observed on the call side. So that means there is the entire effect of theta what we have has been offset by Vega. So since the Vega has gone up, so whatever theta effect was seen, it has been offset by the Vega. Not just that, so we already found out why exactly the far expiry options have highest effect by the volatility. So we can also try seeing that and how far expiry options have been affected. So let me come to April 1st again, and let's go to the December end option. So here, as of April 1st, December end option 20,000 was trading at 144 and 27,000 was trading at 113, right? So just remember these prices, because today when we actually try to look at the same options, right? So as of 28th of May, so we are in a net loss. Right? So how is it possible that what we shorted at 145 is exactly at 145 itself in spite of the market going up, and what we shorted at 113 has actually shot up to 130. So that means for almost around 60 days there has been no decay in the options seen. Why is that the case? Even though there was theta acting on one side, on the other hand we had Vega which actually offset the entire gain made by theta. So you can clearly see, at least with the closer option, we had some amount of profit, but especially with these options, we have literally seen the entire profit get wiped away, right? So we have actually come to a loss with hardly having one single lot. We have a loss of 500 rupees, right? So right over here, so what you can see is the VIX has now come from 10 to 25, and post election, so whenever the VIX is going to come down crashing, so what we are going to see is all these options which have increased their premium because of increase in VIX or increase in the volatility is going to come down crashing. So the entire IV is going to cool off, and because of the option IV cooling off, we are also going to see the option prices coming down. So for example, I will just come to the builder and show you what will end up happening for June end option. So we have already seen for a fact that, right, so the premiums haven't decayed much. So let me just create a 23,000 short straddle for June end. So what I am going to do is not going to change anything, rather just reduce the IV. So the IV is going to start coming down, and I am just going to start reducing the IV. So assuming that on the election day we are going to see somewhere around 20-30% crash in volatility, let's make it 30. So let's make it 30%. So you can see without 1 point change in the entire index. So if the index, even if it doesn't move anywhere, you would have realized a total of 8,000 rupees in spite of market staying at the same place. So this is with respect to straddles. So let me just show you with strangles. Let's say 21,000 and 24,000 short strangle, and let me reduce the IV by 30%, right, or 30 to 35%. So you can see right over here, so even though there is no change in the index, right, almost close to around 70 to 80% of the option premium decay will be realized on the same day just by IV coming down by 35%, right? So this effect will be seen much more on the long term options, right? So if I come to, let's say, December end options, for example, and let me just show you what will end up happening. So let's say you have gone and shorted 20,000, and you have also on the other hand shorted something, let's say 27,000, right? So here again, if I start reducing the IV, so right over here you can see, so good amount of decay will already be realized on the same day, in spite of the index moving. Let's say after election, index ends up moving almost close to around 5%. Let's assume that. So you can see, even though the index has actually moved by 5%, right, you will still be in a profit. Let's actually push it by, say, 8%, right? So even though the index has moved by 7 to 8%, you will actually not be in a huge loss, because the current IV is actually already factoring in this particular move. You can see your break evens are almost 20% away, right? Typically from the beginning itself, the break evens are 20% away. From past 2 months, you have not seen any decay, the premiums have just increased, and all this is going to come crashing down within a matter of a week. That's why you can make use of this raising wicks to create some long-term option trades, and whenever the VIX is going to come crashing down, you're going to benefit quite a lot from that. So now the question is going to be, in case if we get hit and we end up in a wrong direction, so how do we maneuver through, or how do we adjust this entire trade? So whenever you're dealing with long-term options, a simple idea would be to do a martingale. So this would be considered as a very simple and an easy idea, given that you always start with a very low or very less number of lots. So for example, let me just create a same short strangle, and you can see the margin required here is 51,000 to create this short strangle. So if I use, or if I create a short strangle for every 51,000, right? So then obviously I won't have enough money to actually do any kind of adjustment. So you can see, if everything goes right, you can realize a total of 13% within a matter of 6 months, right? So you can also come in closer. Let's say if you believe that the market is not going to come below 21,000 or go above 26,000. So even here you are going to have a break even of almost around 12 to 16%, and you can make almost around 20% just by holding it till December end. But our idea here is not to sit and make 20% from a single trade, because we don't know how things are going to go, right? So even though the margin requirement is quite low right over here, it is advisable for us to always go with lesser number of lots. So what I would suggest is, in case if you use full capital, right, since you already know that there is no margin left to adjust, and martingale, whenever you do martingale, let me just explain what exactly is martingale. You will require additional capital and you will be taking additional risk, right? So my sincere suggestion to you would be to maybe use somewhere around 3 or 4 lakh per lot, even though the requirement is just hardly around close to around 50-60,000. So if you go somewhere around 3 to 4 lakh per lot, so you will be very well guarded. So let me just show you how exactly martingale works. So here what you see is, when I actually open say 20,000 put option December end, it is trading around 152 rupees, right? So you can see this is at 152 rupees. So what happens with martingale is, as in when the market starts to come towards 20,000. So let me just show you the chart, right? So let's say the market slowly starts to come towards 20,000 slowly and steadily, or it can also fall suddenly and start coming towards 20,000. So if it comes towards 20,000, so this particular option right over here can go somewhere, let's say around 700 rupees, right? So what you can see here is the 1,000 point away option, right, is trading at 445 rupees. So what you can do is, once this 150 rupee option becomes 700 rupees, so you are going to close the option at 700 and go 1,000 points away and short 2 more lots, right? So if I short 2 more lots, you can see I am going to get more credit than the previous one. So here I am buying it back at 733, but I am going to short close to around 900 rupees worth of total credits. So I will have call short one side, and on the other hand I am going to short 2 more lots of additional 19,000 put option. So currently this is trading somewhere around 80 rupees. So if this becomes 700, this will be somewhere around 400 rupees. So then what happens is, again, if the market ends up coming down by another 500 or 1,000 points, you can further go away and short 4 more lots of 18,000 put option, right? So what you're doing is, basically every time the market is going to come down, right, so you're going far away and shorting more lots of the put option. So you're collecting the equal amount of premium from the put side every single time the market is coming down. Let us say you square off the option at 400 rupees, you short 2 lots at 200 rupees. So again, if that example, the 200 rupee option went on to become say 300 or 400 rupees, you will cut it at 400 rupees, again pick a 200 rupee option and short 4 lots of that particular option. So you can see that every time you have to multiply and go. So first you start with 1, then make it 2, then make it 4, and then make it 8. But this comes with a huge risk. So if you are suddenly increasing the quantity every time, you will eventually have to go to 16, you will have to go to 32, and so on. And that's the reason if you end up using your full capital, it becomes very risky. So what I would suggest with martingale is try doing martingale only 3 times. Let's say first you start with 1, next go to 2, next go to 4, right? So in the worst case, assuming that things are not working out and the market is suddenly coming down, crashing, right? So whenever you lose more than 3% or 4% of your entire capital, you can just end up squaring off this trade. So why exactly I'm choosing 4% is because this is long-term option and you have some room to hold. So assuming that you have shorted a 20,000 put option, you can simply buy one lot of 21,000 weekly options. So suddenly, in case if there is a fall, it is actually going to benefit you. So this is also something you can do just to stay on the safer hands, right? So this is again going to give you a very good opportunity to do short volatility trades during election. So I have made some quite good money doing this during the last election time. So in 2014, even though I was in the market, so I was not aware about option selling at all. So that time I couldn't make use of it. But in 2019, we got a really good opportunity to do this. So you can also make use of it. And this is a no-brainer because the IV has gone up. You're just betting that the IV is going to come down. The only risk is, let's say BJP will not end up getting a majority. So currently market is pricing in that the BJP is going to become the ruling party, they are going to get the majority. Assuming that that doesn't happen, only then we are going to see very volatile moves, and you can also hedge yourself from that by buying weekly options. Just go much inside. So if you are shorting a 20,000 December option, come inside, buy something like 21,500 put option and something like 23,500 or 24,000 call option in weekly, and then end up selling December end. So whenever there is a knee-jerk reaction, if something bad comes out, so this is actually going to help you. You can actually end up buying 2 or 3 lots instead of just buying 1 lot, and this is definitely going to help you. So this is a small setup which you can try using, and let me know in the comments if you have found this video insightful and what changes you can make. Just make sure that you remember about the position sizing and how many times you are going to adjust, and most importantly when you are going to cut off. So maybe 3, 4 and even 5% up to that level is fine, and beyond that is definitely not okay. So the moment you are hitting an M2M of more than 5% on your capital, it is better you square off the entire trade. Don't try to do martingale and try to firefight extensively. So with this, we also come to the end of this video. I hope this video was insightful. In that case, make sure you hit the like button, share this video, and also subscribe to my channel. Thank you so much for joining.